Welcome to The Explainer. Let's talk about the single biggest enemy of wealth. It's not a market crash. It's not a recession. It's short-term thinking. Look, markets are going to jump up and down every single day, but real, lasting wealth, that's built over years, not minutes. So today, we're kicking off our series on the 7 golden rules of investing with the big one, the foundation for everything else, thinking long-term. And this quote from Warren Buffett just cuts right to the heart of it, doesn't it? It's such a simple but powerful test. Ask yourself, are you just renting a stock, kind of hoping the price goes up soon? Or are you truly owning a piece of a business that you believe in for the next decade? That little mental switch, it changes the entire game. So to really dig into this, here's our game plan. First, we're going to expose what I call the short-term trap. So many people fall into it. Then we'll tap into the wisdom of the giants for some guidance. After that, we'll look at the incredible power of time with some cold, hard data, and wrap up with practical steps for tuning out the noise and building your margin of safety. All right, let's dive right into section 1, the short-term trap. This is the true enemy of wealth. You know, it's not the sudden crash or the scary headlines that usually derail investors. Nope, it's a mindset. It's a way of thinking that is just fundamentally broken from the very beginning. The father of value investing, Benjamin Graham, he drew a really sharp line in the sand here. On the left, you've got the investor. They're thinking in years, maybe decades. They're focused on the business's real value. But on the right, that's the speculator. They're just renting the stock, gambling on minute-to-minute price swings. They care about the ticker symbol, not the company. So you have to ask yourself, which side of the slide are you really on? And this quote from The Intelligent Investor explains exactly why that difference is so critical. The speculator's world, it runs on enthusiasm, that frantic, crazy energy you see on Wall Street. But as Graham warns us, that very emotion, the constant price checking, the impulse to chase highs and panic sell lows, that almost always leads to disaster. So if all that emotion is the trap, how in the world do we get out of it? Well, in section 2, we turn to the wisdom of the giants, Benjamin Graham, and of course, his star student, Warren Buffett. These guys didn't just talk about long-term investing. They actually built the mental models that make it possible. One of Graham's most brilliant ideas was to turn the market into a person. He called him Mr. Market, and you should picture him as your totally manic-depressive business partner. One day, he's euphoric, he's screaming, offering you some ridiculously high price for your shares. But the very next day, he's in a complete panic, begging you to buy his shares for pennies. He's unstable. And the key to dealing with a guy like Mr. Market is realizing you don't have to listen to him. His mood swings are his problem, not yours. You can just completely ignore his daily offers. He is there to serve you, offering a great price when he's scared or a chance to sell when he's greedy. You are the one in control, never him. But let's be real. To have the guts to ignore Mr. Market, you need to own businesses you genuinely believe in. And that's where Buffett's idea of an economic moat comes in. He looks for companies that are like castles, protected by a wide moat, a durable competitive advantage that keeps competitors at bay for decades. It could be a killer brand, a crucial patent, you name it. So we have the right mindset, thanks to Graham and Buffett, but what does the actual data say? In section 3, we're looking at the power of time. And this is where we see the hard proof for why time is your number one ally. The numbers really don't lie, and frankly, they are staggering. This table right here just perfectly shows the magic of compounding. Seriously, just look at that 10% return line. After 10 years, $1 a year grows to almost $16. Fine. But stretch that out to 40 years, and it explodes to over $442. The growth isn't a straight line, it's an exponential curve that gets steeper and steeper. All the real wealth is built in those later years. That's why patience pays big time. And to really wrap your head around what long-term can feel like, think about this fact. For someone who bought at the absolute tippy top of the market in 1929, it took 25 years, a quarter of a century, just for the index to get back to where they started. That is a massive reminder that true patience is measured in decades, not months. But here's the crucial twist to that story. Even during that brutal 25-year wait, the patient investors weren't just sitting there losing money. Why? Well, as this quote says, dividends were the hidden hero. By collecting and reinvesting the cash that the businesses they owned were paying out, their total return was actually positive. It's the perfect lesson. Focus on the business, not just its wild stock price. Okay, so the theory makes sense. The proof is right there in the numbers. But how do we actually do it? In Section 4, we're getting practical with tuning out the noise. I mean, how do you actually build the discipline to ignore Mr. Market when your phone is blowing up with alerts and everyone you know is freaking out? Well, the sources give us a pretty clear path. It all starts with having an investment thesis, knowing exactly why you own a company in the first place. That knowledge is what gives you the power to just ignore Mr. Market's moods. And finally, it gives you the courage to trust your own research, especially when the crowd is running for the hills. And this story from the source material, it just shows this discipline in action. So James watched his investment get absolutely hammered after 2 failed product launches. The market was screaming sell, but what did he do? He went back to his original thesis, his core reasons for buying the company. And you know what? It still held up. So he had the courage to buy more while it was cheap, trusting his research, not the market's fear. And that brings us to our final section. And this might be the single most important concept in all of value investing. This is the bedrock. This is the tool that lets you tune out the noise, have courage, and actually sleep well at night. It's called the margin of safety. Benjamin Graham basically said that the secret to sound investing could be summed up in just 3 words: margin of safety. It's so simple, but it's profound. You do the work to figure out what a business is actually worth, its intrinsic value, and then you only buy it when you can get it for a whole lot less. That gap, that discount, that's your cushion. It's your protection against bad luck, bad timing, or just being flat out wrong. And this quote just captures the kind of calm confidence that a margin of safety gives you. Your conviction doesn't come from a cheering crowd. As Graham says, you are right because your data and reasoning are right. That is the ultimate shield against all the noise and chaos of the market. So that leaves us with one final question to think about. When you look at your own portfolio, are you an owner focused on the long-term value of the businesses you hold? Or are you just a renter getting tossed around by the emotional whims of Mr. Market? Answering that question honestly, well, that's the first real step to becoming a true long-term investor.